there's a stock in my portfolio that's up almost 44% in the last month. However, I'm going to make an argument as to why you shouldn't be following me into this position. And that's what we're going to cover in this channel. So guys, smash that like button, subscribe if you're new, and of course, drop a meow in that chat. You're watching More Money? Let's get it. What's up guys, and without any further ado, the stock that I'm talking about is CROX. And I don't know if I've mentioned it on this channel before, but I've definitely talked about it in length with the Patreons over the last few months, and I actually entered into this position about a month, maybe a month and a half ago. And so you can see here that over the last month, CROX has done really well. They're up approximately 44%, which is absolutely nuts, and of course makes it one of the top performers in the portfolio year to date so far. But the question is, how are they themselves performing year to date? Well, they're still down approximately 40% year to date. And so the question is, what has caused the stock to decline from the high 130s down to around the mid 55s, which is around where we bought it? And then of course now it's rebounding back up to close to the $80 per share area. Well, I want to start with what I saw, which was their Q1 guidance. And so overall, they had really great Q1 guidance, and they actually raised guidance to approximately $10 per share in May of 2022. Now, here was the kicker, and this is why I actually bought into this stock, because that $10 per share in May of 22 relative to the price, and the price per share was around 50 bucks, reflected 4 to 5 times fiscal year EPS guidance. So overall, it was very cheap at the time, and it reflected the ability for the EPS to be adjusted downwards, which I thought could potentially happen in the year. And you can see from their guidance in their Q2 release, that is exactly what did happen. The EPS guidance did come down, albeit just a little bit. Now, I actually do believe that the guidance can come down even further. But here's why I made the position, because even if they cut the guidance by 50%, I was still effectively buying the company at 10 times 2022 earnings at approximately $50 per share. So that was kind of the thinking there. It was a really cheap opportunity. Obviously, it's less cheap now that it's trading closer to $80 per share. And the management really believe strongly in the company, because you can see here that their long-term guidance is defined as fiscal year 2026 for CROX, where they expect to have revenues at approximately $5 billion, and fiscal year 2024 for the recent acquisition of Hey Dude, and the revenue for that is expected to be approximately $1 billion. So in fiscal year 2026, this company expects to earn a little bit more than $6 billion in revenue. And that actually is a triple from where they ended in fiscal year 2021. But one thing that I want to show you here is, you guys already know that I like to dig into the numbers and really have them tell me what the story is. Well, you can see here that very recently, their operating profit margins have been very strong, with both higher gross margins and a lower SG&A as a percentage of revenue. So my question is, does this continue? And I'm actually leaning on the side that it doesn't continue. So when I originally modeled this company out, I actually brought those margins down, and I still had a buying opportunity despite deteriorating the business over the medium term, and then forecasting that out for the long term with the multiple that I was using. And you can see that taking that position was the right move, because overall you can see this is from their Q2 earnings release. So that's why you see 3 months and then 6 months. Overall, you can see that their margins are declining. So the gross profit margins that are declining are right now being offset with lower SG&A as a percentage of revenue, but this is an indication that margins will likely decline further. Now notice that their cost of sales in the second quarter was 48.3%. However, in the previous quarter of 2021 in Q2, it was actually 38%. So it's actually, the cost of sales are increasing. Now, 48.3% is not a bad number, but recall that overall cost of sales in fiscal year 2021 was approximately 39%. So they are being less profitable on the gross margin perspective. And then when you look at the 6 months ended, you can see that it's running at around 49.3%. So this is much higher than where they landed at the end of last year. And even compared to fiscal year 2021 for the first half, notice that in the first half, it was 41%. Now, looking at the SG&A, that 25.8% is very low in the second quarter. But note in the 6 months ended, they're running at approximately 28%. And that's lower than where they were running last year. They're running at 30%. So you can see right now that the declining gross profit margins are being uplifted a little bit with the declining SG&A as a percentage of revenue. However, how long does this relationship hold? That SG&A as a percentage of revenue is at a very low level when you look at them from a historical perspective. So I would not be comfortable forecasting this out. And this is why I recommend to everyone that you gotta build your models out for any company that you buy in detail, because the models tell you a story that just forecasting EPS will not tell you. And this is why I think that I don't like to throw a lot of shade on anybody on YouTube, but I do feel that there's too many YouTubers that are relying on just forecasting out EPS. Well, here's where you can catch falling knives. You really got to understand the story, and the best and only way to really understand the story is model these things out, or at least have a really firm grasp of what the financial statements look like and are saying. And this is why I put on so many free modeling classes on this channel, because I believe it's so important for you guys to learn and get comfortable with modeling out companies. You see stories that you wouldn't necessarily see otherwise. So you can see here that in fiscal year 2022, I actually increased their cost of goods sold to 49% of revenues. Notice how that jumped from 2021, where it was 39% of revenues. And then I continue to increase that. Now, in fiscal year 2023, I bring that up to 50. Now, it could be much higher than that as well. So I'm being a little bit optimistic, I would say, but I'm being pessimistic on their revenue growth levels, because remember, management is guiding to $5 billion of CROX sales on their own by fiscal year 2025, and they're guiding to $1 billion of Hey Dude by fiscal year 2026. So if CROX continues to grow, you would be much higher than the 5.9 that I'm forecasting there, and thus sequentially you'd be much higher on the other years. But I think that they have a hard time growing revenues at a rate of higher than 15% a year. So I'm being a little bit pessimistic, but I think management might be a little bit optimistic in their sort of like long-term growth trajectories. Also note that the real kicker to the valuation is, although they're running at SG&A at approximately 28% of revenue in fiscal year 2022, and that's what's driving their approximate $10 per share in EPS, notice that in fiscal year 2023, I actually bring up that SG&A quite a bit to 35%, and I carry that forward. I do not think that that low SG&A is sustainable, and so I took it up, and that of course impacts my valuation considerably. However, SG&A as a percentage of revenue is something that they can control better than they can control gross margins. And so if there's anything that would remain at its current levels, it would probably be SG&A, but I just don't see that happening. And so you could actually come to a valuation that's much higher than mine if you bring up SG&A at a lower level than what I'm currently doing it at. But this is what I feel comfortable with it at. Let me know what you guys think. Am I missing out on something? Have they provided some sort of disclosure, or have they mentioned something in their conference calls that I just missed here? Now, in my model that you'll get access to if you're one of the Patreons at the lower tier, you will notice that I'm actually forecasting under $1 billion in free cash flow generation by fiscal year 2026. So I'm actually coming under what they're guiding at, but you can see very clearly here that management is guiding for above $1 billion in free cash flow generation annually by fiscal year 2026. But I just think that they're going to have a lot of trouble growing the business at rates higher than 15% annually. And before I get into the valuation, I just want to show you that it's important to look at the balance sheet as well. Notice that they've taken on debt for their recent Hey Dude acquisition. So I do believe that deleveraging is a priority for the company. And as usual, I've penalized their valuation for that level of debt. So there's some additional upside for the valuation as well. So you might actually think that they might pay down that debt over a longer term horizon than what I'm doing it, because I'm not discounting at all. But you could absolutely discount that over like the next 10 years and come to a lower penalization on the valuation than what I'm coming at. So here's another upside to my valuation, but I just like to call it out because I tend to value companies at a very conservative level, and thus I do miss out on opportunities all the time. Now, before I go into my valuation, I just want you guys to know that approximately 80% of the viewers of this channel, or the watch time of this channel, is from people who are not subscribed. So if you can, guys, please take a second right now and subscribe to the channel so that you don't miss out on more great content. And now moving into the valuation, I do believe that this company is worth approximately $167 per share at a 15 times multiple. But notice that I have penalize them for the debt that they have taken on with the Hey Dude acquisition. And once again, you guys could discount this debt, and so it's a lower penalization, but I just haven't done it for them yet. I'm going to take a look at sort of what they guide for their debt amortization at the end of this year, and I might discount that, but for now I'm not. So you can see that at $123 per share, relative to the current share price of approximately $80 per share, the share price as a percentage of valuation is approximately 65%. So it's still cheap, but it's not, that strong buy like it was when I was first buying it at around $50 per share. So this opportunity, I think, makes a lot of sense in the low $50 per share range, but less so at the $80 per share range. But once again, note, guys, that there's upside from the use of a low multiple that I'm doing. And of course, I'm penalizing them for the debt on the balance sheet. And also, I've taken up their SG&A as a percentage of revenue quite a bit. So there's a lot of sort of inputs or levers that you can pull to get a higher valuation. And I want to know from you guys in the comments if you feel as though there's certain levers that we should be taking up. Now, how do you get access to that model? Because I think this one's very interesting. I spent quite a bit of time on this one. Well, you can get access to all the models, including the models trackers that tracks all of the stocks in real time relative to their intrinsic values at the lower tier of the Patreons. And of course, if you want to join us for an epic live presentation every month, that's at the upper tier of the Patreon. Now, one interesting piece of news that's recently come out is that Ray Dalio just exited his position of Alibaba. And that's been one of my strongest performing videos. And if you haven't seen it, you can get access to that video right here.